Hey, welcome back to Two Super Guys Try Stocks. I'm Dylan.
And I'm Vinny. And holy crap, been talking about this for years. We're finally starting to see it actually happen before our eyes. Michael Burry would be proud. Charlie Munger is moving this thing from the sky. I'm pretty sure that's what's happening here. We're going to talk about the earnings report. We're going to get into like my trading plan regarding this and whether or not I continued my bonehead mistake from the last video. Okay. So, if you want to go to the presentation here,
There we
it
go.
was a rather interesting week. Let's just say that. Okay.
Yeah, it was a good
Up
week. Solid week.
13.5%. All right. And it's been a pretty phenomenal year. I want to point out that we're actually up 69% year to date.
Hey, yo.
Nice.
Wait, hold
Only
on.
good things can come from that standpoint forward, right?
Can you go back
So,
to the chart real quick?
yeah.
Just making sure. Okay, we're good. Yeah.
Jim Cramer would definitely approve of that right there. Okay. So what are the headline numbers? There's so much about this that I love. It's not just what the numbers were; it's how management kind of relates to shareholders now. So this is like the first slide that they put up in their presentation deck, and they're giving you like the highlights. What do you really want to know? And it's all
Yes.
things that I legitimately want to know as like a investor owner in this company theoretically. I know I'm not like Warren Buffett here, but tiny little fraction of 1%. All right, so 9% year-over-year growth. Great. That's exactly what I want to see. In particular, their margins improved, which is another fantastic thing. Holy crap, cloud is now growing at double digits, 13%,
Finally.
11% when you control for inter-unit revenue. Just another
Finally.
great point. Yeah, I know, right?
Jeez.
And then the Alibaba International actually had pretty solid growth, and they even talk about it. We'll get into a little bit later, but they're looking like it's going to be profitable this year. So yeah, another arm of the business coming to fruition after years and years of growing and developing it. Right? And as far as like how strong is this financial fortress that they built over this last few years, it's still sitting on a positive net cash position of almost 52 billion US dollars, which went up almost $2 billion in the most recent quarter.
Okay.
Yeah.
All right.
Sexy, sexy
Very,
Mexi right
very
there.
sexy. Solid numbers.
So, the second slide of the presentation, kind of in this Josiah era, has been what is going on with capital allocation, particularly share buybacks. Right now, if you notice, as he assumed control here, the share buyback numbers just started really significantly increasing here: 2.9, 4.8, 4.8, 5.8 billion. They even talked about this in the conference call. They went out and borrowed $5 million just to do share repurchase, 4.1, and then now 1.3 in the most recent quarter. Because they're now dual primary listed, we get daily updates on them, right? So you can kind of see what their trading strategy is here, and they start to taper off the purchases around $100 USD per ADS, and below 80, as they said in the conference call, we thought we were significantly undervalued. So they were aggressively buying back in that territory, which is good to see them being stewards of capital, right? They're not just blowing it all and share buybacks at a PE of 600 like some of the other companies listed in the US do, right?
Right. Which actually happens more often than you think, which is shocking.
Mm-hmm. Absolutely. Yeah, we did a separate video on Coles where I mentioned that. They still have a significant portion. I can't remember if it's on here. Still allocated for share buybacks. I don't see it real quick reading this over. But they still have a fair chunk authorized. I want to say it's like 19 billion, but I can't remember exactly what the number is there. But I don't think we're going to see as many share buybacks going forward. That's a little disappointing.
So, but do you interpret that as they think they're overvalued? Because
No.
if they're still thinking undervalued, then the amount shouldn't matter. So they would
Okay.
say
Yes.
that we are no longer undervalued.
Yeah. Ultimately, what is a business designed to do? It's designed to generate excess capital and reinvest it in the most efficient or highest growth opportunities possible. And share buybacks are number two. Number one is internal reinvestment. If they see areas for return on invested capital of 15% or more, it doesn't make sense for them to be buying back shares, right?
True.
And they really should be investing internally, which is the phase we're moving into.
Right. And that's fair, especially if it's going to go to cloud. Then that makes sense.
Yeah, exactly. That's where it's all gonna go. We'll talk mostly about that at like the end when we're into the conference call and stuff. So, all right, income statement. Now, when you're talking about Alibaba, a lot of this is driven by their kind of holdings in other companies. But when you're looking at the core line here of this income from operations, 83% year-over-year growth is just phenomenal, right?
Yeah.
As far as the other highlight numbers here, looking at big triple digit growth in percentages. Now, this is in part because it was a positive year as far as like their investment growth compared to last year, which was negative. So I wouldn't really take a whole lot of stock in that, if you will. I care more about how the core business is functioning and what are they doing as far as free cash flow, right?
Yeah. These are flashy
So
numbers because they had like two bad quarters a year ago. It doesn't. That's fine.
yeah, exactly. So when we get to the cash flow statement here, we're seeing what they're doing as far as their reinvestment goes, right? Look at this. Remember, this is renminbi. This is not in U.S. dollars here. But look, purchase of property, plant, and equipment. This is their capex. This is them investing in servers and server farms, right? 7.2 billion renminbi. In the quarter last year comparison,
Yeah.
this quarter
Jeez.
31.3.
Okay. All right.
Yeah.
I mean, Meta did the same. Well, I mean, a lot of companies did the same, to be clear. But Meta
Yep.
was kind of famous for it. That's a lot. That's a big
Exactly.
increase.
Yeah, and then $5.3 billion still in free cash flow this quarter. Okay,
That's
so
meaningful.
still a sexy number. Yeah, whether or not we can count on that, that's a different question. All right, and then this is what they talked about: the positive net cash position, 51.8 billion. All right. Now, they put this slide in there for years. Dylan and I have owned Alibaba for several years, but this is allowing you to look at the individual segments in terms of their, percentage of revenue to see whether or not anything is eating up a lot of the revenue, right? So their cost of revenue here actually went down a little bit, which is a good thing. They got a little bit more profitable on like the top line as far as the gross revenue. Product development, they're spending a little bit more on R&D, okay? Sales and marketing did increase slightly, 12.7 to 15%. And then the general administrative, they brought it down slightly. So they are investing strategically for growth. You can tell that this is a different company, different mindset here, that they're investing more in R&D, they're investing more in sales and marketing expenses, but they're controlling their costs in terms of the cost of goods sold and then the general administrative stuff, right? And then
Yeah.
they're changing where they're investing their capital. So we're getting into a different phase, different era of Alibaba share ownership here. All right. So this is the segment revenue, all right? In terms of that, both the revenue growth is this line right here, and then we actually have the EBITDA change year over year. So if you look at the revenue growth year over year percentages, 5%, 32%, 13, -1% basically here, 12%, 8%. So they're growing multiple segments of their business pretty considerable paces, right? None of them are really rivaling Taobao Tmall Group in terms of the overall size as of now,
Right.
right? When we look at the EBITDA percentages here, this is whether or not each individual unit is profitable. We're seeing some bigger numbers here, right? So 2%, that's like the core business, not really moving the needle here. 57% on the Alibaba International. They really are hoping this will be positive this year and that this will be the first year. They did say that this will be a positive number and it'll be actually accretive to profits. But it's been growing rather significant pace, 32%. All right. The cloud, we talked about this 13%, 33% growth in terms of EBITDA. So it is not only growing in terms of its portion or year over year growth in terms of revenue, but it's actually growing in terms of its profitability too, particularly because they've had margin expansion as they sell more profitable or higher margin items from the cloud side, where they're getting into the more of their AI server space rather than just like server farms for more non artificial intelligence purposes, right? So those are more profit centers.
Yep.
And then the smart logistics, I don't remember what they mentioned in this one, but not great performance in terms of its actual growth or its EBITDA, but it's never really anticipated to be a major profit source for them. This is kind of the thought process here. Local consumer services, another one, decent growth here, and then 71% increasing EBITDA, and then these down here really don't move the needle much
These
for
are
them.
super small.
Yeah, exactly. All right. So segment by segment kind of analysis here. So Taobao Tmall, this is the big one. This is the one that really matters for now, right? This is equivalent to the ad business for Meta. In general, the idea here being it was more profitable. All right. So they did have a decrease in 9% as far as their direct consumer sales, but it was because they chose to stay away from these categories. But they had like a 9% increase in their customer management revenue, which is the one that they really want. The CMR is that higher profit margin portion of this Taobao Tmall business. This is the one that people are really worried about being a decrease over time. This is where they've moved to less of a retailer, as Charlie Munger talked about them as, and more of a platform. So that's the number you want to grow, right?
Got it. All right. Hmm.
And if you really care about like the VIP sort of stuff here, there are 49 million members of their VIP service. That's equivalent to like Amazon Prime is the idea. So
Okay.
those are people that are paying to be part of this club where they get kind of faster deliveries, and these are more typically higher income households and people that have a more frequent contact with them. So it's something that over the long run will benefit Taobao, Tmall, and Alibaba significantly. All right, international. All right, the big thing here, like I said, was that growing significantly, 36% year over year, which is a very, very big growth rate, and that they're hoping that it'll finally be profitable this year. There was a question asked on the conference call about whether or not ultimately they think that the international segment will have a wider profit margins because of the lower competition internationally. And they were like, it's too early. We can't really say anything about that. But certainly having this unit that's growing this fast, then hopefully being cash flow positive would be phenomenal for Alibaba. It's no longer supporting this elephant, if you will, of unprofitable business.
I respect the conservative statement because other people have been like, "Oh yeah, it definitely could be, it definitely could." You can really dig
Yeah.
yourself a hole real fast. You kind of realize
Yeah.
that the more of these that you listen to. So, I mean, conservative dude, I like it. He's definitely spending Alibaba's money significantly more intelligently than the last like
Uh-huh.
2 years.
I absolutely agree, and I'm really excited about like the future opportunities here. Listening to this conference call, it very much had a different tone than other prior Alibaba phone calls. In my experience, it had a more of a growth mindset and less of a, what are we talking about in terms of like return on investment today? So this
Right.
is more meta than it was like say. What's a good example of like someone that was like a return on investment today that I've listened to? Uh, I'm trying to think
Tim
of
Cook.
what's that?
Tim Cook.
Yeah. Okay. Yeah. Yeah. Less Apple, more Meta. It was
Yeah.
it was the flavor I got from it. So cloud segment, all right, 13%. It was like 11% once you eliminated intra Alibaba segment kind of growth. Which okay. I wouldn't have included that in the headline number if we're up entirely up to me, but it's still 11% solid growth there. Now, as far as like other steps forward, this is really where their investment is going to be. They're going to go opening up like the doors in terms of cloud infrastructure building out over the next 3 years, right? And what are they seeing as far as that goes? They refused to give a number in terms of what the revenue from the AI products was. Someone asked, and they were like, we can't really divulge that. But we are on our like second year of triple digit growth, right? So what
Okay.
the number is, don't know, but it's growing very very fast. Right?
All right.
And it's definitely a competitive industry. So they did ask about the margins compared in China to like the rest of the world, and they were like, "Yeah, we don't think we'll achieve the margins here in China that we will in the rest of the world." Which I'm not surprised by that. They're not going to see the Amazon Web Services or Google
Right.
like margins, but
Did
something.
they, when they asked about AI, did they bring
Uh,
up Apple at all or no?
no, no,
Apple's
I
phones
don't remember
deal?
mentioning it at all.
Damn it. Okay.
Yeah. Oh, I mean, that is a news story that came out too. That is, to my understanding, confirmed. But I don't know how much they expect it to move the needle for them. Right.
Okay.
All right. So conference call notes. All right. So the tone of this conference call was entirely about AI. All right. That's literally all they were talking about. This is an interesting point right here. They said they're going to go into the 3 years with relatively flat capex, where they're going to spend a lot. All right. They said in the next 3 years they're going to spend more in capex than they have in the last 10 years combined.
I like it. Go for it.
Yeah,
100%.
that's what basically they were saying is that the AI is a once in a generation opportunity, and they're going to do everything they can to capitalize on. Right?
I would 100% agree. Now would be the time to spend money. So 100% go for it. I'm even okay not even buying any shares back for the next 2 years. I know that that's bad. That helps. But Meta's a great example of putting your money where your mouth is and having it work because they went from 80 to 700 in like 3 years
Yep.
because he was right.
Absolutely. I guess I'll make my final point here in a minute, but you're seeing the capital allocation change, right? That they're not going to be as aggressive with share buybacks since the share prices come up some, and they have this 3-year plan of investing significantly in their capex for AI infrastructure. And then finally, they're divesting the non-core assets. We saw this with the disposition of SunArt, which I guess they said it already has regulatory approval, so they expect to close it, I think, in March or June of this year. They have other units that they're interested in, kind of disposing off their balance sheet. So, all right, you want to go full screen? What's up?
Oh, I was gonna ask you. Oh, here's the slide. Okay.
Yeah.
I was
All right.
before you showed me the slide, I was gonna say, well, this is gonna hurt your free cash flow yield. How do you feel? Because this is
Yeah.
going from more of a growth to something different. Okay. All right.
Exactly. Yeah, it's an entirely different animal at this point. So this is my free cash flow yield calculation. Basically, this is where the market cap is 341 billion. They have 52 billion dollars net cash. Last quarter, they had 5.3 billion dollars in free cash flow. If you analyze that out, it's like 21.2 billion. Right. However, they haven't done that over the last 12 months. If you do look at the trailing 12 months free cash flow, it's actually this like 11.7 billion. So a much smaller number.
Right.
Depending on which one you use to calculate your free cash flow yield, you either get 7.3 or 4.1%. And this
Which
is
is
a long ways off from where they've been in the past, too.
16. They were at 16 last time you did this.
Yeah, yeah. So I mean, stock price goes up, yield's going to come down. That's completely logical, but it's a different business right now. If you want, like I said, if you want to go like full screen, we'll talk about it. Investing in Alibaba at this point, it's not the same company, right? At one point, it was a company with a significant kind of discount to fair market value. Now, what you're looking at now is you're looking at a company that had basically very minimal growth. You're looking at a company now that has had much better success with growth, and they're investing heavily. They're going through like a 3-year investment cycle where they're going to try to propel themselves forward in terms of their growth in the top line, and eventually they get rewarded with that. But it's going to be a very different company going forward for the next several years. Now, the new management team, I think, has done a phenomenal job in terms of allocating their capital. They saw how undervalued the shares were. They were buying back aggressively, and they tapered that off as it's come up in price some. Whether or not it's a fair market value is a different question for everyone. But I think you're going to have a different mindset with this company now. Certainly, when you were at $80 a share, it was like the value was there, even if the business didn't really do anything phenomenal. Now you're really kind of investing at these prices with a expectation that the management's 3-year capital kind of program is going to have rewards on the backside, right? So it's like, it has the potential to be a much better longer term investment, but you're going to have to be much more patient with it in getting there because they have this investment cycle of 3 years.
10-year hold, essentially. I'm glad you talked about that because I was going to say, wait, actually, before I do this, our last video, you did a covered call at 125. What did you end up buying it back or no?
I did end up buying it back. I did lose money on that covered call, but I still own my shares.
Okay, good call. Because like I said, if the AI is moving so fast, it's so absurd. And if you can capitalize on all the money that's being allocated to AI, dude, I mean, this could be huge. So I think I'm at like 390 shares. I think my cost average is like 105 or something. I think yours is better than mine.
Yeah, that's because of the covered calls. I think I was able to shave like almost $20 a share off of my cost basis by doing that over the last couple of years. But now it's like dancing with the devil a little bit, especially when you're up 69% in a month and a half.
Yeah,
it's
crazy.
Not a face for that anymore.
Crazy.
Stupid.
All right, guys. Let us know what you're thinking and what you think is going to happen to Alibaba in the future.
To the moon, baby.